The speed at which AI agents are evolving is truly mind-boggling, isn't it?
It really is.
They're gaining these incredible capabilities to, perform and refine tasks almost like humans. But what happens when we take these advanced AI agents and point them at something as, well, fundamentally human and complex as managing money, making investment decisions?
That's a million-dollar question, isn't it?
Yeah. So today, we're plunging into this really fascinating experiment. It's called AlphaAgents, developed by researchers at BlackRock. And it's basically assembling an AI, dream team to tackle equity portfolio construction. The big question is, can a group of these digital minds truly outthink, human biases and all the market complexities?
Well, traditionally, human research analysts have had to wrestle with just an absolutely enormous amount of information, really staggering.
Like what specifically?
We're talking 10K and 10Q reports. Those are the detailed annual and quarterly financial filings companies put out, plus earnings calls, market news, sector reports. I mean, so much more, all just to pick stocks and build portfolios.
Wow.
And it's not just that it's incredibly data intensive. It's also highly susceptible to human cognitive biases. Things like loss aversion or overconfidence.
Right, the behavioral finance stuff.
Exactly. Behavioral finance, building on Kahneman and Tversky's work on prospect theory, has really shown how these biases can consistently lead to, frankly, suboptimal investment decisions.
Decisions you wouldn't make if you were purely rational.
Precisely. And what makes it trickier is that these biases are often unconscious. So traditional fixes like, simple checklists or just being aware of them, they have pretty limited impact.
Okay.
And that's exactly the tricky problem AlphaAgents is trying to tackle.
Got it. And that's really our mission for this deep dive then. We're going to unpack how this team of specialized AI agents actually works together, how they even debate amongst themselves, analyze stocks, build portfolios, and crucially, how they actually performed when they were put to the test. Okay, so let's maybe unpack that immense task facing the human analysts a bit more. You're saying they need to gather, process, synthesize this huge variety of info disclosures, real-time news, sector reports.
Everything, yeah.
It just sounds like a monumental effort simply to stay informed.
It is.
Let alone trying to generate alpha, that finance term for consistently beating the market.
Exactly right. And beyond just the sheer volume of data, that critical human element often comes into play. The cognitive biases we mentioned. They're often unconscious, which makes them incredibly difficult to mitigate, even if you have the best intentions.
Right.
And this is precisely where AI offers, well, a really compelling advantage, particularly in its ability to rapidly process these vast data sets and potentially mitigate those inherent human tendencies.
So if human biases are so ingrained, are we saying AI can just eliminate bias completely? Or is it more about reducing it? And I wonder, are there maybe new biases AI might introduce that we need to look out for?
That's a really crucial question. The goal isn't necessarily to eliminate bias entirely, because that might be impossible. It's more about reducing its impact. AI brings a certain objectivity to data processing and decision-making just by, sticking strictly to its programming, its logic, which helps avoid those human emotional pitfalls, like getting too optimistic or too fearful.
Okay.
But as for new biases, absolutely. AI systems can definitely inherit biases that are present in their training data. That's a known issue. Or they can develop what's sometimes called algorithmic bias, which is why transparency and explainability, something we'll definitely get into, are just so vital in these kinds of systems. You need to see why it's making a decision.
Okay, that makes sense. Now, this is where the approach gets really innovative, you mentioned. These recent advances in large language models, LLMs, have really opened up new possibilities. And this AlphaAgents framework, it proposes this novel approach, a multi-agent system. So multiple LLM-powered AI agents working together, collaborating, even, you said, debating, to collect and synthesize all that equity research input.
Yeah, and a key insight here is that the system is designed to emulate the specialized roles you'd find in a human portfolio management team. It's not just one sort of super AI doing everything. It's a team of specialized micro agents, you could call them, each with distinct expertise and tools.
Like different analysts on a team.
Exactly. And this collaborative approach, the idea is it enhances the quality of reasoning, leverages diverse domain-specific expertise, and crucially helps mitigate those human behavioral biases we keep talking about. They even built in an internal debating mechanism to address differing conclusions or, importantly, potential hallucinations from the AI.
Hallucinations. That's when the AI just makes stuff up. Right. confidently wrong.
Precisely, which you definitely don't want when managing money.
Definitely not. Okay, all right, let's meet these AI financial analysts then. It's like a specialized squad.
Yeah.
First up, you mentioned the fundamental agent. This sounds like the real workhorse, digging through those massive corporate reports, the 10Ks and 10Qs. How much heavy lifting does it really take off a human analyst's plate?
Oh, tremendous amounts, honestly. This agent automates what used to be an incredibly labor-intensive process. Analyzing those detailed reports, sector trends, all the raw financial statement data.
Right.
It uses specific tools like a fundamental report pool tool for grabbing public financial data automatically using something called the A-Finance API, and also a financial report RAG tool. RAG is retrieval augmented generation. It's tailored specifically for financial statements.
Okay.
So it can analyze cash flow, income, operations, flag areas of concern,
Good.
basically giving a full financial health checkup on a company.
So it's getting the core facts right without getting tired or bored, which is key.
Absolutely.
But financial markets aren't just about facts, are they? There's a lot of feeling involved. So next up is the sentiment agent. How does this one get a pulse on the market's mood?
Yeah, this agent is all about the mood. It really keeps its finger on the market's pulse. It analyzes this constant stream of financial news, analyst ratings, company disclosures, using sources like Bloomberg Financial News.
Oh, the headlines, the buzz.
Exactly.
Yeah.
And it provides recommendations based on the prevailing market sentiment it detects. What's neat is it's equipped with an LLM-based summarization tool that uses something called reflection-enhanced prompting.
Reflection-enhanced prompting. What's that?
It basically means it's explicitly told to reason, critique, and refine its summary before it gives an informed recommendation on whether to invest.
Huh. So it's like it double-checks itself? Has a little internal debate first?
Kind of, yeah. It improves the quality of its final output.
Interesting. Okay, and finally, we have the valuation agent. This one sounds like it focuses purely on the numbers that tell a stock's story. What kind of metrics is it crunching?
This agent dives deep into the quantitative side, the hard numbers. It analyzes current and historical stock prices, trading volumes, typically using data from Yahoo Finance. It uses a computational tool to calculate key metrics like annualized cumulative return.
Okay, average yearly return.
Right. And annualized volatility.
How much the price swings around.
Exactly. And based on those calculations, it provides a clear valuation assessment: buy, sell, hold, based on the numbers.
Gotcha.
And what's strategically quite brilliant here, I think, is that each agent only gets access to the data relevant to its specific job.
Ah, so they stay in their lanes.
Right. Keeps things focused. And this modular design also means the whole framework is incredibly scalable. You could easily add more specialized agents down the line, maybe a technical analysis agent looking at chart patterns, or, I don't know, macroeconomist agent focusing on broader economic trends.
That modularity does sound incredibly powerful, especially for adding capabilities later. But what really seems to set AlphaAgents apart, and you touched on this, is this idea of the agents working together. So once you have these individual experts, how do they actually become a cohesive team? How do they make a single decision?
Yeah, that's the coordination piece. They use what's called a group chat assistant.
Like a project manager for AIs?
Sort of. It coordinates them, makes sure every agent gets a chance to contribute at least twice in the discussion. Then it takes all their individual analyses and consolidates them into one comprehensive stock analysis report.
Okay, but that brings up the obvious question. What happens when these expert agents don't agree?
Right, because they won't always agree, just like human experts.
They're not just presenting findings side by side, they have to collaborate.
Exactly. So the framework includes this multi-agent debate mechanism.
Okay.
If their analyses diverge, they basically engage in a structured round-robin debate until they reach a consensus.
A debate between AIs. That's wild.
It is. But it's crucial for improving the overall reasoning capability of the multi-agent system. And it also helps reduce those AI-specific issues like hallucination and the confidently wrong stuff. Recent research actually supports this idea that debate improves AI reasoning.
So the debate actually makes the final answer better, potentially.
That's the goal, and you can even review the full discussion logs, the whole debate transcript.
To transparency.
Exactly. Which is a huge advantage for evaluating how these collaborative AI systems work and trusting their outputs. The whole thing, by the way, runs on the Microsoft AutoGen framework and uses GPT-4o as the underlying LLM.
Right. And you mentioned an example, Zscaler.
Yeah, the paper mentions an instance with Zscaler where the agents had conflicting views initially. They went through this debate process, resolved the conflict, and arrived at a consensus decision.
Real teamwork, just digitally. It's fascinating. But okay, beyond the objective analysis, how do these AI agents factor in something much more nuanced, like an investor's tolerance for risk? Humans aren't all the same there.
This is really insightful, I think, because it mimics how human advisors interact with clients. The system embeds investor traits, like risk tolerance, directly into the agent instructions using prompt engineering.
Prompt engineering basically telling the AI how to behave.
In simple terms, yes. So, for example, the valuation agent might look at company A and say sell if it's operating under a risk-averse prompt, maybe pointing to high volatility.
Okay.
But that same agent, given the same data but a risk-neutral prompt, might recommend a buy, maybe emphasizing positive momentum instead.
Huh. So it interprets the data differently based on the risk profile.
Exactly. It allows the agents to interpret risk contextually rather than just using fixed, hard-coded thresholds.
That's pretty sophisticated.
It is. Although, interestingly, the study did find that the risk-seeking and risk-neutral profiles ended up generating almost indistinguishable outputs.
Oh.
Yeah, which suggests there might be a current limitation in how well prompt engineering can differentiate between very similar or closely related risk profiles. There's still nuance AI needs to capture better.
Okay, so it's not perfect, but the concept is there.
Right.
All right, let's get to the bottom line then. The real test of any investment strategy is performance. How did alpha agents actually do when it came to picking stocks?
Okay, so the researchers ran back-testing experiments. They focused specifically on stock selection within the technology sector, and this was over a 4-month period starting February 1st, 2024.
Relatively recent then.
Yes. And they compared the multi-agent portfolio's performance against portfolios run by single agents, specifically the fundamental and valuation agents on their own, and also against a benchmark index. The key metric they used was risk-adjusted return, the Sharpe ratio.
Sharpe ratio, basically. How much bang for your buck, considering the risk involved.
Precisely. Okay, so what stands out, particularly in the risk-neutral setting, is this. The multi-agent portfolio consistently outperformed the benchmark, and it also outperformed both of the single-agent portfolios.
Outperformed across the board.
In the risk-neutral test, yes. Both in terms of total cumulative return and the rolling Sharpe ratio over the period, which really suggests that combining those different perspectives, the shorter-term insights from sentiment and valuation with the longer-term focus of the fundamental agent,
Right.
it genuinely creates a more effective, more holistic strategy.
Okay, those risk-neutral results, beating the benchmark and the individual agents, that sounds pretty striking. Does it really validate the whole multi-agent idea? When you say outperformed, are we talking small gains, or was it a significant difference?
No, it was quite a compelling difference, actually. For instance, in that risk-neutral scenario, the multi-agent portfolio generated a cumulative return of about 25.4% over the 4 months.
Okay.
Compare that to the benchmark's 18.5%. And the single-agent portfolios lagged even further behind.
Right, that's a substantial gap, not just incremental.
Not at all. It's a pretty significant edge in that context.
Okay, but that was risk-neutral. What about the other side of the coin?
Right. So stepping back and looking at the bigger picture, when they tested it in a risk-averse setting, well, here, all the agent-selected portfolios, including the multi-agent one, actually underperformed the benchmark.
Oh.
So the AI lost to the market in that case. Why?
It was mainly due to the market conditions during the test period. The technology sector saw really strong gains.
Which tend to be more volatile stocks.
Exactly. So conservative portfolios, which is what the risk-averse setting generates, they, by design, largely excluded these more volatile tech stocks.
So they missed out on the big run-up.
They missed the upside, yeah. It clearly illustrates that classic trade-off you always have in investing between mitigating risk and chasing potential returns.
Right.
And what's really insightful here, I think, is that even this cutting-edge AI system isn't immune to those fundamental market principles.
Yeah, that's a powerful reminder.
It shows AI is a sophisticated tool, not, a magic wand. The art of balancing risk and return, still paramount, even with automated systems.
That's a crucial point. It means the core finance principles don't just vanish because you're using AI. It actually makes the human judgment about when and how to apply these AI tools even more critical, maybe? I think so, yes. But even within that risk-averse scenario, where it underperformed the benchmark, the multi-agent approach still showed some advantages, didn't it?
It did, yeah. Which might make you ask, well, why bother with the multi-agent approach if it's still underperformed in that risk-averse case?
Good question.
And the answer seems a bit nuanced.
It is, because even though it underperformed the benchmark, The multi-agent portfolio still did relatively better than the individual single-agent portfolios in that risk-averse setting.
Okay, how so?
Well, it showed slightly lower volatility, fewer big swings, and it had reduced drawdowns.
Drawdowns being the drops from peak value.
Right, the peak to trough decline. So it indicated an improved ability to mitigate losses compared to the single agents acting alone. The multi-agent approach seemed better able to balance the risk tolerance across the different agent perspectives, sort of filling the gaps between them,
I see.
which led to a more robust outcome, even if it was still conservative overall.
Okay, so wrapping this up then, what does all this really mean for the future of, say, equity research and portfolio management? What's the big takeaway?
I think AlphaAgents represents a really important foundational step towards what you might call agentic investment systems, systems where AI agents take on more autonomous roles. It demonstrates that coordinated AI agent reasoning can significantly enhance decision quality, and importantly, help mitigate those pervasive human cognitive biases we talked about.
And it produces actual recommendations.
Yes, it generates robust stock assessments, and crucially, it provides explainable outputs through those discussion logs.
Right, the transparency.
Which is absolutely critical for building trust and allowing proper evaluation of AI systems, especially in finance. It's not just a black box spitting out answers.
Makes sense.
Now, it's not quite a full portfolio optimization engine yet. It picks stocks, but doesn't necessarily construct the perfectly balanced portfolio. But the framework really aligns well with how human discretionary managers work, synthesizing diverse research inputs. It even mirrors that investment committee-style reasoning you see in firms, where differing perspectives get debated and reconciled.
Okay.
Which makes AlphaAgents seem really well-suited for augmenting or perhaps automating parts of human-in-the-loop decision-making, especially in institutional settings. It promises more scalable, more transparent components for future portfolio management systems.
So enhancing the human manager, not necessarily replacing them entirely, at least not yet.
Exactly. It's about making humans smarter, more efficient, and less prone to certain biases.
Wow, that was a truly insightful deep dive into this world of AI-powered financial decisions. It's pretty remarkable to think about AI agents, not just crunching data, but actually debating and collaborating like a human team. What a potential paradigm shift.
Indeed. The potential for these multi-agent systems to bring a new level of, perhaps, rigor and objectivity to complex fields like finance is, well, truly significant. It's a very exciting time to be watching this space.
For you, our listener, we really hope this has given you a powerful shortcut, a clearer picture of how advanced AI is starting to reshape one of the most traditionally human-centric areas out there, finance. So thinking about all this, what stands out to you? How do you see AI reshaping fields like finance or maybe even other complex areas? Or perhaps, how does understanding the way these AI agents work, collaborating, debating, managing biases, change your perspective on making complex decisions in your own life? Something to think about.